$5,000 a month in dividend income from $25 a week. Sounds like it shouldn't work. Stay 10 minutes. It does. In this video, I'll show you and John simple and practical tips that investors keep secret. I'll show you the drip strategy and how to make it even better. I'll show you a hand-picked 5-stock portfolio for this strategy, and in the end, I'll show you how this portfolio of stocks turns $25 a week into a portfolio worth $760,000, paying over $5,000 a month in dividend income. So grab your $25. John has his. Here's the goal. John wants to retire one day and see monthly income hit his account, like the paychecks never stopped. But the problem is, he only has $25 per week to spare. So the only strategy for this is using the DRIP investment strategy. Okay, so here's how DRIP works. DRIP stands for Dividend Reinvestment Plan, and it's basically the difference between getting paid for your investments and growing them. Here's a simple example. Say you own 100 shares of a stock worth $20 each. So you've got $2,000 invested. The stock pays $1 per share in dividends every year. That's $100 a year. Now here's the choice. You can take that $100 in cash, or you can use it to buy more shares of the same stock. With $100, you can pick up 5 more shares. Now you own 105. Next year, those 105 shares pay you $105 in dividends. You reinvest again. Now you own about 110 shares. The year after that, 116, then 122. The number keeps growing, and so does the dividend check without you adding a single dollar. That's the snowball. Small at first, massive 30 years in. But here's the thing, DRIP on its own is slow. With $2,000 sitting in the account, year-one dividends are $100. That buys 5 shares. Useful, but the snowball takes a decade to really start feeling like anything. So John adds one more layer to this strategy. Every week, $25 goes into the portfolio. New shares get bought immediately. Those new shares start paying dividends right away. Those dividends buy more shares. 2 engines running at the same time, the weekly contribution and the dividend reinvestment. That second layer is what changes the math. DRIP on its own is slow, and $25 a week is small. Run them together for the long term, and the result is the kind of number that makes the rest of this video possible. But that only happens if the 5 stocks underneath are the right ones. Here's where most dividend portfolios go wrong. They chase yield. A 9% payout looks irresistible until the company cuts it the moment earnings get tight. So John doesn't start with yield. He starts with 4 specific filters. Filter 1, blue chip dividend stocks, the defensive anchor of the portfolio. Big established companies that survive recessions and keep paying through them. Companies that operate in healthcare, utilities, consumer staples. Filter 2, dividend aristocrats. Companies that have raised their dividend every single year for at least 25 straight years. The streak itself is the proof. If a company has paid through the dot-com bust, 2008, COVID, and everything since, the dividend isn't going anywhere. Filter 3, a dividend ETF anchor. One pick that gives John exposure to about 100 dividend-paying companies, all screened for quality, broad coverage, low effort, instant diversification. Filter 4, a growth-oriented dividend stock, the engine. Lower yield, but the dividend grows so fast that 15 years in, the yield on John's original cost basis is double what it started. 5 stocks make it through these 4 filters. And by the end, I'll show you how a portfolio built from these 5 turns $25 a week into a portfolio worth $760,000, paying over $5,000 a month in dividend income. But first, let's quickly cover the 5 stocks. Stock 1 is the controversial pick, United Health. Ticker UNH, one of the biggest healthcare companies in America and a stock that's been through a lot lately. Lawsuits, controversy, negative headlines, the price has pulled back hard. But here's why John picks it anyway. That pullback is exactly what makes the math work. New money buying UNH today gets more income per dollar than the people who bought 2 years ago. And the long-term dividend growth tells the bigger story. UNH carries a 2.24% dividend yield, a 16.02% dividend growth rate, and 10.75% in annual share appreciation, and that growth rate beats every other blue chip in the portfolio. That's the defensive anchor in place. Next, John reaches for a dividend grower. First of which is Home Depot. It's been growing its dividend every year for the past decade. One of the biggest home improvement retailers in the country and one of the most consistent dividend payers in the entire S&P 500. On Home Depot, the numbers come in at a 3.13% dividend yield, 14.14% dividend growth, and 8.2% annual share appreciation. And the yield is what separates HD from most growth-oriented stocks. So, UNH covers healthcare, HD covers retail. The next pick brings something neither of them has: a dividend streak. What kind of company raises its dividend every year for 27 straight years? Boring ones. Payroll software kinds of companies. ADP runs payroll for hundreds of thousands of companies. Every 2 weeks, when those companies pay their employees, ADP gets paid. Recession, boom, pandemic, companies still have to pay people. That recurring revenue is what convinces John this is a good pick. The dividend isn't going anywhere. ADP delivers a 3.17% dividend yield, dividend growth of 12.25%, and share appreciation around 8.58%. And that yield is the highest of any individual stock on John's list. Next up is a dividend ETF, SCHD. SCHD does something for the portfolio that no individual stock can. It holds about 100 of the strongest dividend-paying companies in the U.S., screened by quality, cash flow, payout ratio, dividend track record. Every holding has to clear all three filters before it gets in. That means John gets exposure he wouldn't have built himself. Sectors his research missed, stocks he might have passed on, companies he hadn't researched yet. Diversification on autopilot. Across SCHD's roughly 100 holdings, the blend works out to a 3.32% yield, 10.43% dividend growth, and 8.14% annual share appreciation. And that 3.32% is the highest yield in the entire portfolio. Time for the fifth stock, and a curveball. Morgan Stanley, ticker MS, the investment bank, the asset manager. The kind of company nobody puts on a dividend list until they see the numbers. Here's why John picks it. MS has grown its dividend at a 20.89% annual rate over the past decade, the highest growth rate of any stock in this portfolio. The share price has compounded at 16.41% per year. The yield isn't huge, standing at 2.08%, but the dividend growth is moving in a way most blue chips can't even match. Okay, so all five together, $5 a week per stock, $25 total. The math is a simple average across all five. For the dividend yield, add 2.24% plus 3.13% plus 3.17% plus 3.32% plus 2.08%. That comes to 13.94%. Divide by 5, and the blended yield lands at 2.79%. You can do the same for the dividend growth rate and the share appreciation. Run those three averages, and John's portfolio settles at a 2.79% dividend yield, 14.75% dividend growth rate, and 10.42% annual share appreciation. And the combination of those three is what drives every dollar that comes next. Now, the question is, can this portfolio return enough over time for you to retire? Let's find out. Year 1, John puts $25 a week into the portfolio. By the end of the year, the balance sits at $1,300, basically his contributions, assuming 52 weeks in a year. Year 5, the portfolio is projected to reach $8,522. Dividends would start picking up. Year 10, $25,189. This is where compounding would start to show up. Year 20, the portfolio is projected to reach $135,131. The market is now adding more to the portfolio every year than John is. He's still putting in his $1,300. The portfolio would grow by tens of thousands of dollars. Then year 30 comes. The portfolio is projected to reach $760,788. Annual dividends would land at $60,390 with monthly income of $5,032. Out of that $760,788, John's contribution adds up to $39,000. That's it. Capital appreciation is projected to add another $411,663. Reinvested dividends would add $310,124. What if you wanted to hit $1 million in 10 years starting from zero? I built a Fidelity plan that does exactly that, and I'll show you exactly how John reaches it. That video is on screen right now.